Good morning, traders. Vix Trader here. I hope you had a happy holiday season last week. I thought do a video to talk about today's trade. The market is up big on trade news pre-market. It's like the SPY will be up about $5.25, at the open. And this is where traders can get a lot of trouble trading these big gaps. This is where FOMO kicks in, fear of missing out. And I thought I'd cover how to handle such situations so that how to trade successfully. Um, One thing to keep in mind, one of the things that could happen is with the market, the best thing to do in situations like this is to really just wait and see how the market pans out. Um, if we look throughout the week, last week, one of the things I always teach is the very first candle of the day. And you can see better in this chart. Last week, if you see this was the first candle of Friday, price action tends to move right and touch the top of that candle or the bottom. It touched on the top of that first candle of the day, the first 50-minute candle on Friday. Then on Thursday, same thing. Market opened down. But look, it touched the top of the candle and the bottom of the first candle of the day. I draw these lines to see how throughout the day, this is the first candle right here, and it touches it. Then we had this gap up day on trade news, and you see, throughout the day it touched until you get this big igniting bar, and the market gapped up. And you said, well, how do I trade this? It never came touching it. Well, yeah, then you can trade on this 5-bar moving average. So you say, oh, we got a gap up. It's a bullish day, great, but where do I buy? The spiders. You can buy the spiders when it touches this green line, the 5-bar moving average, or I use it to short the TVIX. So anytime I want to short the TVIX on an igniting bar, I will wait till the SPY touches this green bar and starts moving upwards. Or the other thing is I would short TVIX, when the SPY touches the top or the bottom of this candle. So this is a computer-driven market, and you see that in a computer-driven market, everything's methodical. There really isn't emotion involved, just methodical. The market's going to open up here right around the 100-day moving average, which is the 281.20 price. We'll see how it handles it. I expect it to hold, but market could quickly reverse. It could gap up here and keep going higher this way, or you could sell off down into this trend, based on a tweet, or bond prices are falling again. You see that bond prices, this is the 30-year bond. When this thing drops or the 10-year drops, the market tends to get concerned about interest rates, and that could damper the mood. Well, we will see. Throughout the day, we have some indicators we talked about. My primary indicator, which is this bar, this 6 p.m. bar, which you see is around the low is 296, the high is 287, and we'll see if throughout the day if it violates this. If it goes below the 2807 area or the 2796 area, and that to me that's a bearish situation, and for me I would stay out. So how do you trade this? Be patient and just wait. Don't let FOMO. One of the ways to control FOMO, fear of missing out, is to have price points. Like if the SPY gaps up, I'll wait for either the 5-bar moving average to catch up. I will see what the primary candle is, the speed of the primary candle right around here. I'll see, does it go below this, the price action? I could short some there, TVIX. Or I could short here TVIX when the spiders touches here. Or what I really like to do in this situation is wait for this green bar, this green line, the 5-bar moving average to catch up, somewhere around here, because we have to understand in a computer-driven market, there's a lot of mean reversion. So, I could do a no trade because I expect Tuesday or Thursday will bring mean reversion, meaning that the price somewhere around here will come somewhere catch up with this. This will catch up to that, so the price should go down. This line could go up, along with the 5-day, which is this red line, and the price will be lower, or at least at best flat, which means I have limited upside for the day, but a lot of downside risk. A good example, if you look at the daily, see how even these big gap movements all throughout the trading, up or down, that the price action the next day, we had a big gap down here. Look, it moved right back up to that yellow line, the 3-day, and you had a big gap up here, but the next day, mean reversion came right back down, touched the 3-day, where the 3-day continues to move up and the price continues to move down. It's where they touch together, and so those are things to keep in mind. These gaps, that happen, you know, um, like around here. If I can move this thing. But the prices come down here. It had a big gap down here. The next day went right back up to the 3-day. So I expect Tuesday, the market's closed on Wednesday for President Bush's memorial. I expect the price to gap up here and somewhere on Tuesday or Thursday to meet mean reversion to this yellow line, at least, if not the red line. It's a bullish situation, but you don't want to get caught up shorting the TVIX around here and have the TVIX go up in price as the spiders comes down. Or if you're going to go long the spiders, you don't want to buy the spiders at the 281 area and have it go down to 270, 279, and then say 280, 279 when you're down $1 or $2, because you bought the gap. So that's how you handle FOMO. Those are some rules I have. I thought, my indicators, this is my monthly January candle. It's way above the 267 price. This is the spiders, this is the futures price, and we'll see what it does. But we got to keep in mind, how does it handle the number of the day for me is 280-120. How does it handle the 100-day moving average? When the market opens around 280-120 area, the 3-day is going to be at 277.66, and the 5-day is going to be at 276.60, which means I would expect the price to close today or tomorrow somewhere between this 281 and 277 area. And if you want to short the TVIX, you want to short the TVIX somewhere between this price, but not above the 280-120, because you're risking this mean reversion to come back down. I hope this video helps. Thank you for listening. VIX Trader here, signing off on Monday, December 3rd, 2018. Bye-bye.